Hello and welcome to our weekly market roundup, your one-stop source for the latest in global market trends, key economic insights, and top financial news. I'm your host, Daniel, bringing you the highlights and the happenings from around the world. Let's dive into the numbers and stories that moved the markets last week. It was a mixed week for global equities, with varying performances across different regions. In the US, small-cap and value shares outpaced large-cap growth stocks for the third consecutive week. The S&P 500 declined by 0.83%. The Nasdaq Composite dropped 2.1%. However, the Dow Jones Industrial Average managed a modest gain of 0.19%. The Russell 2000 value rise by almost 4%. The Pan-European Stocks X Europe 600 Index rose 0.55%, boosted by a Friday rally driven by positive earnings reports. Japan's stock markets experienced significant declines. The Nikkei 225 Index fell by 6%, and the broader Topix Index dropped by 5.6%, primarily due to pressure on technology stocks following sell-offs in US mega-cap tech companies. Chinese equities fell as central bank rate cuts failed to boost confidence in the economic outlook. The Shanghai Composite Index declined by 3.1%, and the blue-chip CSI 300 Index was down 3.7%. In Hong Kong, the Hang Seng Index retreated by 2.3%. The yen strengthened for the third consecutive week to around 154.2 against the USD, impacting Japanese exporters' profit outlook. The pound remained stable against the USD as markets awaited the results of an audit of UK public finances, which could reveal a significant deficit and lead to potential tax increases. The euro strengthened slightly against the USD. Crude oil prices fell by over 2.5% due to demand concerns in China. Gold price edged lower and lost more than 0 to 5% in the previous week amid mixed batch of economic data from the US. Significant declines in major tech stocks, with Tesla down 12% and Alphabet down 5% after earnings reports contributed to market volatility. Mixed economic data included disappointing new home sales in June, but strong durable goods orders and consumer spending growth. The core PCE price index rose 0.2% in June, maintaining an annual rate of 2.6%, supporting expectations for a Fed rate cut in September. European equity markets experienced midweek declines as earnings from technology and luxury goods sectors weighed on returns. Negative sentiment from steep declines in Tesla and other major US tech stocks impacted European tech shares. Ahead of the Paris Summer Olympics opening ceremonies, French President Emmanuel Macron called for a political truce. Travel disruptions caused by arson attacks on high-speed rail infrastructure marred the opening but did not significantly affect the French index. Core Eurozone government bond yields decreased, following weaker-than-expected flash PMI readings, boosting expectations for monetary easing. Markets began pricing in 50 basis points of interest rate cuts from the European Central Bank for the rest of 2024. UK Chancellor announced an upcoming audit of public finances, potentially revealing a $20 billion deficit and prompting tax increases. The Bank of England introduced a new funding facility for non-bank financial institutions to prevent bond market volatility, with mixed economic data leading to speculation about a possible interest rate cut in August. The yen strengthened to around 154.2 against the USD from 157.45, impacting Japanese exporters negatively. This strength was attributed to government intervention, unwinding of short positions, and narrowing US-Japan interest rate differentials. The yield on the 10-year Japanese government bond rose slightly. Investors speculated on potential rate hikes and the gradual tapering of the Bank of Japan's massive bond purchases, expected to be detailed in the July 30-31 monetary policy meeting. Japan's economic data highlighted persistent inflationary pressures, with the core CPI rising by 2.6% year-on-year. Flash Purchasing Managers Index data indicated a return to growth in Japan's private sector, driven by service providers, while manufacturers saw a slight reduction in output, reflecting a mixed but cautiously optimistic economic outlook. The People's Bank of China cut its medium-term lending facility by 20 basis points to 2.3% and its 7-day reverse repo rate by 10 basis points to 1.7%. Additionally, Chinese banks reduced their 1- and 5-year loan prime rates by 10 basis points, aiming to support consumer borrowing and economic growth. China's GDP growth undershot expectations in Q2, and data for June showed slowing retail sales, industrial production, and property investment. These indicators pointed to broader economic weakness and the need for further policy support. The third plenum, a significant meeting of top Communist Party officials, concluded with President Xi Jinping emphasizing high-quality development, but without detailed policies to boost consumption or address the property slump. This lack of concrete measures contributed to negative market sentiment. Analysts expect continued policy easing, including potential reductions in the reserve requirement ratio, as the central bank aims to bolster economic growth. However, the initial rate cuts did not provide the anticipated confidence boost to the markets. What to watch this week? The upcoming week is filled with crucial economic data releases, ongoing company reports, and several central banks meetings. These factors could greatly impact market sentiment and drive volatility. Here is what to keep an eye on. That's a wrap for this week's Market Roundup. Thanks for tuning in. Be sure to subscribe and hit the bell icon to stay updated with the latest market news and analysis. Until next time, stay informed and stay ahead. I'm Daniel, and I'll see you next week.